So when I look at investing, I like the idea of investing in stuff that I think will continue to churn out income no matter what its market value does. And that for me means investing, if anything, I'm tilting more towards credit investing where you get 8, 9, 10% in interest. And all the company has to do is just pay its debt, as opposed to equity investing, which I still invest in, but I'm tilted more towards credit now than ever. And with equity, the S&P 500 pays a 1.5% dividend. So if you want to make the same 8, 9, 10%, you've got to count on getting capital gains of another 6, 7, 8% every year in addition to your dividend. So when I look at the possibility of, what might happen over the next year or whenever, to me, that's a lot riskier to be betting on a capital gain as opposed to just betting on getting my interest, even if the companies that owe the money aren't going anywhere. Their stocks might be in the tank, but as long as they don't crash and burn and go bankrupt, they'll pay off their debts.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. The Buffett Indicator currently stands at almost 200%, one of the most extreme readings of overvaluation in its history. Now, with stocks so richly valued, prudent investors worry that stretching for further gains from here may not be worth the risk, which is why more and more of them are starting to prioritize investing for income over appreciation. Now, a few months back, I interviewed Steven Bavaria, creator of the Income Factory framework, about the merits of constructing a lower risk portfolio of income generating assets that include high yield bonds, high dividend stocks, senior bonds, covered call funds, master limited partnerships, closed-end funds, and more. Today, Steven returns to drill down on the specifics of credit investing, an area that many investors don't have much personal experience in, but offers attractive returns and relative safety in today's market environment. Steven, thanks so much for joining us today.
Thank you, Adam. It's a pleasure to be back.
Thanks. Well, we had a really great response to your first appearance on this channel. I think investing for income is something that is appealing to more and more people, but they just don't have much of a background in it. So your first appearance on this channel, where you gave a really detailed walkthrough of your whole Income Factory approach, was sort of like, I think, rain on the dry desert sand. People were just really hungry for that type of education, and the response to it was, phenomenal. So anyways, great to have you back here. Got a number of questions for you. Want to really dive into the details of credit investing. But before we do, if I can just start with the general question I like to kick these discussions off with, what's your current assessment of the global economy and financial markets?
Well, there's a lot going on out there. Some of it geopolitical, some of it local political here in the United States, a lot of it economic, interest rates. And if anything, it's more volatile than ever, I think, as far as what could happen. And I think as we get closer and closer to our election, without knowing what's going to happen, what the aftermath will be, that's not going to change for a number of months. So when I look at investing, I like the idea of investing in stuff that I think will continue to churn out income no matter what its market value does. And that for me means investing, if anything, I'm tilting more towards credit investing where you get 8, 9, 10% in interest. And all the company has to do is just pay its debt, as opposed to equity investing, which I still invest in, but I'm tilted more towards credit now than ever. And with equity, the S&P 500 pays a 1.5% dividend. So if you want to make the same 8, 9, 10%, you've got to count on getting capital gains of another 6, 7, 8% every year in addition to your dividend. So when I look at the possibility of, what might happen over the next year or whenever, to me, that's a lot riskier to be betting on a capital gain as opposed to just betting on getting my interest, even if the companies that owe the money aren't going anywhere. Their stocks might be in the tank, but as long as they don't crash and burn and go bankrupt, they'll pay off their debt. So I see lots of volatility. And of course, I'm an old credit guy, so I spent my life doing credit, and I'm kind of used to what credit markets are all about and how to play in them. So I'm more than ever kind of conservative in my outlook, and just betting on corporate America and corporate the rest of the world to just muddle through and stay alive and pay their debts. And I'm not betting on them doing anything too heroic as far as their stocks going up.
Okay,
Continue.
so yeah, one of the key takeaways that I took from our previous conversation, which I think you're putting your finger on here, is to be an equity investor, you're really betting on continued success of the company that you're investing in, that it has to do better next year than this year, grow earnings, and that's going to grow my stock price. And that's that appreciation you were talking about. Yeah, I'm going to get some dividends, but if I want to make up that difference, it's largely going to be an appreciation. And so therefore the company has to be even more successful as time goes on. With credit, what you're saying is you just have to play for survival. I'm just betting the company is not going to die. So as long as it's still alive and still able to meet its debt payments, that's all I need it to do. Who cares what the stock price of the company does? As long as it's still got a beating heart and it's still making its payments, that's all I'm asking for of it. Correct?
You could do my speeches, Adam. No, that's exactly right. And I call it, when I look at the difference, to me, credit is what I'd call the existential risk. It's the risk that the borrower is not going to exist anymore. It'll go bust. It won't pay its debts. It won't pay its bills. With an equity investment, I would call that the entrepreneurial risk, but it includes in it the existential risk. In other words, when you're buying stock in a company, obviously, the company has to stay alive first. That's job one. But then, in addition to that, in addition to staying alive and paying its bills and it's paying off its credit, it also has to grow its earnings and its dividends. So you're taking more risk. It's another level of risk to buy equity than to just buy debt. It's that you're buying the entrepreneurial and the existential risk. With equity, you're only buying the existential risk with debt. So unless you're pretty sure you're going to make more than you would make by just buying the credit, when you buy equity, why take that extra risk? So the typical equity return over the last 100 years has been 9 or 10%. So if I can make 8, 9, 10% in the credit markets, just taking the existential risk, to me, I'm a coward. Why take that extra risk unless I'm really sure? And honestly, it's hard to be really sure in the equity markets that you're going to do better than average. In fact, most people who try to do better than average do worse than average because they do things that are kind of heroic. They try to time entry, they leave the market at certain times, and then they're not in the market when it goes up. So I sort of take the 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 less heroic route. I is what I call credit.
Got it. It's funny. I was just on this past weekend's weekly market recap. We were sort of talking about bulls and bears, and I kind of introduced this new animal called the turtle, that just has a very defensive mindset but keeps moving forward. And this sort of seems like a nice turtle type strategy, right? Where you're just taking the lesser path on risk, but you're just using time to your advantage here.
I think Aesop came up with this idea years before us with his tortoise and hare
Yeah,
story.
he beat us by a couple millennia. Yeah.
Exactly. I don't know what kind of investor he was, but I'd like to think Aesop would have been an income factory guy.
Okay, so I want to ask you to describe the income factory here in just a second, but just to make sure I'm correctly understanding kind of your general outlook, I think you would say, at least what I hear you saying is, hey, look, there's, there are conditions to invest in equities, there's conditions to invest in fixed income. For a conservative-minded person, maybe the income approach is better more often than not. I would imagine the older one gets, where we can afford, to take big losses less. Probably the income factory approach makes even more sense. But also entering into a market environment like we have right now, where you're saying, you're seeing increasing volatility, and as you look further out, you see future volatility. it really does make you want to take your turtle approach, I'll say that, versus your coward's approach, and just take kind of the
Tortoise
safe
is the
Eddie bet.
word. Yes.
Yeah. Okay. Great. And I guess one other thing too, just before we get to your definition of income factory, is if I remember correctly from our previous conversation, with equities, there's all sorts of things that can impact your return. All right, the company might not perform the way that they thought and disappoint analysts, and then the stock gets repriced. The company might decide, hey, you know what, we're going to invest for future growth and we're going to cut our dividend for a while, right? I mean, there are lots of things that are out of your control that the company can decide to do. Whereas with credit, it's a contract, right? So the company is saying, I am going to do this unless basically I cease to exist. And so you've kind of, you've got greater seniority, and obviously, even if the company does get into real trouble, starts going into receivership or whatnot, you're going to be ahead of all the equity holders anyways, and hopefully still get at least something. But basically, your odds of getting your contract filled are higher, and sometimes substantially higher, than the much more squishy agreement with the equity holders, correct?
Absolutely. Because when you think about it, the only event that is going to cause a credit investor not to get paid 100% would be a default. I mean, a formal default. Default typically leads to bankruptcy. Sometimes companies get worked out, but one way or another, a default means you're failing to pay interest and principal on a loan. And that only happens, I mean, recently in the last couple of years, default rates for the whole corporate uh, cohort have only been about 1% per annum. The people who've been predicting a hard landing, a recession, have been predicting 4 or 5%, but we haven't had any defaults, anything like that. And even in the big Great Recession of whatever it's been now, 15 years ago, it got as high as about 10%. So when you start, and as you said, well, loans are secured by collateral. Even high yield bonds, which are unsecured, tend to get back 40 or 50% of principal when they default. Secured loans get back 60 or 70%. So typically, even on a defaulted loan or bond, you're going to lose perhaps 50% at the most. Well, for an unsecured, you might lose between 40 and 60%. So you're going to get back about half of what your principal is, which means that at a 4% recession level default rate, you're only going to lose half of 4% of your loans and bonds. So that's a 2% loss. That's not that big a loss. If you're earning 8 to 9 or 10% per annum in interest, and you lose 2% of your portfolio, that'll reduce your interest income that year. It won't even touch your principal. So the losses, even when you have serious levels of default, are mitigated because you've got that you've got security, or you've got the position of a creditor which is above equity, so you get whatever's left of the company before it totally goes out of existence. So yeah, there's a limit to how much you're likely to lose, even in the worst of times, if you're a credit investor.
Okay. So what's I think appeals to this to a lot of people is that here you're really just putting math and probabilities in your favor here, right?
That's right. And one more thing I wanted to mention, because you mentioned as people get older, or their situation changes, they may be in a different position with their respect to risk. All A 25-year-old and a 65-year-old, I mean, if they're in a growth mode, a lot of 65-year-olds are still investing for the long term because they hope to be 85 or 90 someday, and they don't want to run out of money. So you can invest for the long term with an income strategy where you're investing in credit and getting back 9 or 10% a year in cash, and just reinvesting that and compounding it to create your own growth at 8 or 9 or 10%. Or you can invest in equity where you'll get the 1.5% dividend yield and the company internally will grow it and hopefully will grow. But either way, you're getting the same sort of growth, whether you get your 8, 9, 10% in cash, or whether you get it in capital gains, or whether you get a combination of it, you're getting the same total return and the same potential growth if you reinvest, keep your money in the investment. The difference comes, so as a 25, 35, 45-year old, you can grow your money with an income strategy just as much as with an equity strategy, especially if you're in an IRA where you don't have to worry about paying any gains,
Hmm.
as it. And most long-term investors for retirement are in 401ks or IRAs. So an income strategy works best in a tax-deferred environment. But once you get to be retired, where let's say you've been growing your compounding your capital over time, either in growth stocks or in income or a combination of both. Once you hit that point where you're retired, and now you want to start taking out 5-6% per annum, now all of a sudden you have to take that money out every year to live on, whether or not you've earned it. And here's where an income strategy can be a real advantage over an equity growth strategy. If you're in equity and you're earning 1.5% yield, but you need 4, 5, 6% to live on in retirement, you've got to sell some
Right.
of your capital every year to generate that extra income. Well, if the market's down, you've still got to sell. So you're kind of permanently reducing your capital at a lower price if you have to sell when the market's down. In other words, if you stay in equities once you're retired, you're requiring yourself to sell whether the market's up or down, uh, because you need the money. If you're in an income strategy where you're earning cash 8, 9, 10% a year, and that's being generated by your capital, but you're not touching your capital, then even if you've got paper losses or paper gains, if the capital varies in value each year, but you're just living off the income, then you can take out of your 8, 9, 10% you're receiving in cash, you can take your 4, 5, 6%, live on it, and then you still have 2 or 3% to probably reinvest. And if the market's down, you're actually reinvesting that at a bargain price, uh, which can actually be an advantage. So there are some real advantages to having uh, an income approach, an income strategy once you hit retirement and need to take money out year after year, whether the market's up or down.
So, Stephen, every time I hear you talk, I feel like more and more people should be following this lead. It just seems so much more appropriate, especially for the older investors out there. But I read all these stats that say that, you know, older investors are more exposed to equities uh, at this time than at any other prior point in history. Why is that the case? Why do you think people don't understand and most people don't even really have the experience, buying a lot of these credit instruments? Not because they're super sophisticated. It's just that I guess people are just more comfortable buying ETFs and bonds and stuff, or ETFs and stocks. But why does your approach sound so novel and new when it's really made up of a lot of stuff that's been out there forever?
Institutional investors, large institutions, pensions, large merchant, investment banks, and commercial banks, and college endowments have been doing what I've been talking about for years. Now they've had mixed portfolios where they've had some equities, but they've been investing in more sophisticated credit products like senior loans, high yield bonds, and especially like collateralized loan obligations, some of these more exotic credit products that now you can buy through funds. They've been doing this for years, but retail investors have not so much. And then the other big deal, I mean, some of us of a certain age can remember back when people worked for corporations and they'd work for a company long enough that they'd get pension funds. Now, a lot
Hmm.
of companies have done away with pension funds and have replaced it all with 401ks, which then, which then roll into IRAs for most people. Once people leave a job and go to another job, or they, even if they're at the same one, usually you take your 401k once you're retiring and you roll it into an IRA. But one way or another, you are the one now investing for your retirement. You're not depending on some large corporation to be setting up a pension fund for you, and then later on you retire. And the focus then was, how much is my pension going to be? Back when people got pensions, and I'm old enough, I have some pensions from jobs I had earlier in my life, and I've also got an IRA that I manage myself. But for people who had pensions, they never had to worry about how the money was being invested to create their pension. They just focused on, how much is my pension, and is it going to grow, and once that stopped, I don't know if it's been 25, maybe 30 years by now or so, since most people began to move off of the idea of collecting a pension someday and into an IRA or a 401k that would become an IRA. At that point, they all started having to think about, oh my gosh, I have to make these decisions myself. I'm my own pension fund, instead of with somebody else. And of course, once that happened, who'd they turn to? They turned to the media. I mean, you had the rise of CNBC and Fox Business and Bloomberg, and other places became where people would go to learn about investing, to hear about investing. And of course, CNBC is set up kind of like ESPN is for sports. I mean, why do people watch ESPN all the time, even if it's not the season of the particular sport they care about the most? Because ESPN is like all sports all the time, and they make it interesting. And they have a panel of people talking about them constantly, and you
It's
get,
entertainment. Yeah.
and it is. Well, CNBC has done the same thing. They follow the markets day to day, minute to minute, all day long. And what are they looking at? They're looking at growth. Or movement in price. If everybody were doing income investing, where you just invest, like your tortoise, you invest in stuff and then you just collect the income month after month and reinvest it. There's not much of a story there, which we like, those of us who do it, and it helps
Right.
people sleep at night. But the market, the media has kind of, I won't say brainwashed, but it's trained people who didn't know anything about investing previously to think that investing is worrying about the movement of stocks day to day, minute to minute, and that's what they invest in.
Right. Well, and also too, you have to look at, well, how does CNBC make its money? Well, advertising. Okay, who are its advertisers? Well, it's the big companies like BlackRock and whatnot that are trying to drive people to specific ETFs, right? So, they end up sort of promoting the products that their advertisers want them to push, which is not sort of these credit instruments that you're talking about.
Right. And the type of investing that those ETFs are participating in. So it's not surprising that people, they hear about, when I started writing about what I now call the income factory 10, 12 years ago on Seeking Alpha, I had people literally, virtually calling me a heretic, in the comments, like, oh no, if you want to grow, you've got to have growth stocks in order to grow. And I would say, hey, math is math. 10% cash plus 0% capital gains is the same as 0% cash dividends and 10% capital gains. It's, you reinvest and compound them both and you'll get the same growth, or you'll have the same total return if you take it out each year to live on it. Took years for people to kind of accept that. And now I have so many people that say, oh boy, I wish I'd known this years ago, because it's working and I'm sleeping better.
Well, so, we're putting our fingers on the big reason why I founded Thoughtful Money, really the core reason why I founded it, which is our education system does a very poor job of teaching us financial literacy. So to your point, when somebody has their money in their 401k at work, and then eventually they end up leaving and that gets spun out and converted into an IRA, they're all of a sudden in this position where they're like, well, I guess I'm in charge of it all now and I don't know what to do, right? So they get influenced by things like the media, like you're talking about, right? So, what we're trying to do here is just bring on money experts who can help shore up some of the deficiency in that financial literacy. And you're doing a great job for that here on this, fixed income and credit investing side of things. So let's get into today's topic, which really is about credit investing, which is a part of the income factory strategy. Before we get into that, though, can you just, for folks that didn't see our prior interview, where we really dove deeply into the depths of why you created the income factory and what it is and how it's constructed, can you just give the quick elevator summary to them of your income factory method?
Sure. The the reason I call it the income factory is because actually that term describes perfectly the philosophy I kind of came up with for this. If you think about Ford Motor, and they build a factory to build cars and trucks, about a week after they build a new factory, nobody at Ford is even thinking about what the factory itself is worth, except maybe the accountants in the back room. But their business isn't buying and selling factories. So they're not worried about really how much they paid to build that factory or to buy that factory. What they concern themselves with is how many cars and trucks does it produce? And then how do we produce that output from year to year? And which means they take some of their profits from selling those cars and trucks and they buy new machines for the factory. So the factory grows and its output grows over time. And I said, that's the way I think about my portfolio. My portfolio is my factory. Once I think about the main purpose of the assets that I own is to create income, is to be invested and create income, and that income is just like the output of my factory, then if I'm in an accumulative mode, if I'm not retired yet and living on the output of the factory, but I'm growing it, then I'm just going to use that income to reinvest in new machines each year. And the beauty of it all is if the market is down and I'm making the same amount of money, same amount of cash, but I can reinvest it at bargain prices actually to buy new machines for the factory. So I may be now making 11% on the machines that when I bought them last year at a higher price, they only yielded 10%. So that's the basis for, for the name Income Factory. But I think the name captures the essence of the investment philosophy. And just to get kind of academic on us, there was a John Burr Williams is an economist who wrote in the 1930s, about the same time that Graham and Dodd were writing about Benjamin Graham about markets. And John Burr Williams wrote a book and came up with this idea that the real value of any investment asset is the discounted current value of the entire stream of cash that asset's going to create over its life out into the future. And once you think about that the real economic value of the assets is the cash it's going to produce for you today and tomorrow and every day forever while you're around and while the asset's around, then it's easy to understand then that markets actually reflect that value. In other words, the markets in an efficient market will over time eventually reflect that value and not be it's not the be all and the end all is not the market value. It's that economic value that the asset creates, the value of that cash. And then that will get reflected in a market value. But it's the cash that I really care about if I'm investing to use that cash someday to live on or leave it to my kids or whatever.
All right. So I love the analogy. Totally easy to understand. Only comment I would have about the analogy is either pick a different company than Ford, or if you're going to keep Ford, they don't make cars anymore. So it's only a truck manufacturing company anymore, a truck and SUV. But no. And look, I cut my teeth early in my career, as an investment banker, and did a lot of discounted cash flow models. So I'm very much in tune for thinking the way that you think, right? Which is, hey, at the end of the day, what the company's worth is what that discounted future stream of cash flows is going to be. And at the end of the day, don't get distracted by story. Don't get distracted by any of the sizzle that Wall Street tries to sell you on these things. At the end of the day, it's how much is this really going to earn over time, and what I'm paying right now, is that a good value relative to that future cash stream? And in your case, what you're basically doing is creating something that an equity investor might need to wait a long time before the value of that cash streams really fully gets justified in the price appreciation they want to see. In your case, you're getting paid year after year after year on this, so it's a much safer way. If you think about it, almost like a garden. It's like, hey, I could wait until some mythological point in the future where I can go and get all my food, or I can just be getting food every day, every week out of the garden as time goes on. And I think for most investors, they'd much rather have the security of that than the uncertainty of having to wait for an uncertain bounty. All right, well, look, in my intro, I ran through a number of the different assets that you use to build an income factory. These are things like senior bonds, high yield bonds, high dividend stocks. So you've got equity in there. Covered call funds, master limited partnerships, closed-end funds, and other types of assets as well. And I think in our previous interview, we kind of gave the little elevator pitch on each one of those. This one, I think we're going to be diving much more deeply into credit itself, the actual, I guess what most folks would call bonds here. Is that correct?
Yeah, when we talk about credit, it's very important to differentiate credit from what's often called fixed income. Most of the investment world differentiates equity from fixed income, but fixed income for most investors is actually treasury bonds and investment grade corporates. And you don't have much credit risk in any of that, which is good if you're not looking for credit risk. But what you are betting on, those are longer term bonds, usually fixed rates, low yields. You're getting paid very little to take what is essentially interest rate risk, because you're going out with fixed rates for so long. With real credit investing, we're not taking those kinds of risks much, because credit investing is floating rate, or if it's high yield bonds, it's short term, usually no more than about 5 years. And you're getting paid real returns, 8, 9, 10%, to take, as I said before, real risk, where there is risk of default. But then when you get defaults, it's minor in relation to the total amount of your portfolio and the total income you're earning. So, so credit is non-investment grade for the most part, and it's senior loans, which are secured by collateral, and it's high yield bonds, which are unsecured, but which are still senior to the equity. So in both cases, you get some of your principal back from secured or unsecured assets that come to you first as the creditor if the company defaults. Now, senior loans are secured, and they're also floating rate, so your interest rate changes every 3 months in most cases, so you have virtually no interest rate risk. High yield bonds, as I said, are fixed rate, but it only goes out about 5 years.
Again, then this is where I think investing in credit really starts to feel like terra incognita to the regular investor who invests in stocks, right? I think one of the emotions that many investors probably are feeling as they're hearing you describe this, right, is you're saying, okay, this is not investment grade. You are looking to assume credit risk here. So people start thinking, okay, well, wait a minute, these are these if we're in the barrel, we're getting down closer to the bottom of the barrel, aren't we here? And are these companies that are going to go out of business or whatnot? Now, you've already talked a bit in the past about how if you look at the actual default rates, they're not that bad. So, in many cases, you're going to be collecting these tasty income streams. And even if there is defaults, even if we get into a rough economic patch, it's likely not going to be big enough that the defaults will actually, you'll still be able to absorb those and still make a positive return in any given year. And so I wonder, is this a little bit sort of like the old Michael Milken era, back where he became the quote unquote junk bond king, but part of his success was realizing that high yield debt, which used to be colloquially called junk debt back then, was actually it was undervalued. It had a higher perceived risk than it actually really had, and so he was building these portfolios and making a very nice return on them, but being able to buy them at attractive valuations because people were unrealistically nervous about them. Is it somewhat similar to that?
It's exactly that, and I'm glad you brought that up. Traditionally, if you go back 40 years, the only companies that could borrow in the public bond markets were companies that had investment grade ratings. That was triple B and higher. Most of corporate America is non-investment grade. Most of the companies that many of us work for and are familiar with are in fact not investment grade. And in the old days, if you will, before Michael Milken and the advent of so-called junk bonds, those companies would always borrow from banks directly. And the other companies that were investment grade had their choice of floating bonds and selling them publicly, or selling commercial paper, which was also sold publicly and was essentially an investment grade product. So what Milken and Drexel did in the 80s was to open the bond market to companies that were not investment grade and had previously not been able to float public bonds. But those are the majority of companies, and it's unfortunate that they got the label junk bonds, because they are high yield bonds. Definitely, they include they have real credit risk as part of them. But as we've said, you get paid well for that, and it's limited. Even though it's real, it's limited to 1-2% in most years, and 3-4-5% in bad years, and maybe 10% when you get a really great recession like we had 15 years ago. What's interesting, though, is that many investors, as you were referring to, who are so scared by these high yield, junk bonds, when you ask them, well, do you own any mid cap stocks or small cap stocks? And they virtually all say yes. If they have balanced stock portfolios, they'll all have at least funds that are mid cap funds, small cap funds. And I say, well, do you realize that all those mid cap and small cap companies are non-investment grade? And that even some of the S&P 500 in the large caps are non-investment grade. So here you are swearing you'd never buy the debt of these companies, but you're buying the equity, which is below the debt. So all the equity you buy in small cap and mid cap companies is worthless if the debt of those companies that you say is too risky for you to buy doesn't get paid. So I'll buy the debt of these companies, and as long as I get paid, then you might make some money buying their stock. But I'm sure to get paid, even if your stock doesn't go anywhere, as long as the company.
Isn't that crazy? I am sure that there are, plenty of people watching this video who up until now have said, I'm just not comfortable going into the high yield space. I'm not going to touch that debt. And yet they own mid cap and small cap companies that issue that exact same debt that they're eschewing, as you just said, right? And it's interesting because the debt, they're worried about the existential risk, right? Well, that company might go out of business. I don't want to own this debt. But if you own the equity, you get the exact same existential risk plus all the entrepreneurial risk on top of that, right?
That's right. I was sort of cursing at my car radio the other day. I was driving home from something, listening to Bloomberg radio, and they were interviewing somebody about the markets and what they would invest in. And they were saying that, oh, we like the bond markets. They like them because they think interest rates are going to go down, and so bonds might go up in price. And so they were talking about it. And then they said, but of course, only buy investment grade. Don't buy those risky junk bonds. And I'm listening to this person who was supposedly a real expert, on all of this. And I wanted to jump through the radio and grab them and say, do you know what you're talking about? Because there are a lot of people, even people who are serious professionals in this market, who just dismiss high yield credit investing as something that's too risky and you wouldn't want to do it. But as we both just said, they're taking all these same risks, but lower in the balance sheet.
Yeah, it's crazy, and also too, I didn't hear the exact thing you heard on the radio, but also I think sometimes there's also a difference of perspective that maybe sends mixed signals. So my guess is what they were reacting to, as you said earlier, people that invest in investment grade debt, there you really have to pay attention to interest rates, right? Because that'll impact the valuation of your debt. And there are a lot of people, like right now, there are a lot of people that are wrestling with, well, should I go further out on the duration curve with bonds right now? Because if interest rates come down, that's where you're going to get the greatest amount of capital appreciation. And so, okay, if that's what you're looking at, if you're looking at the debt as an appreciation vehicle, then yes, you have to look at it that way. And yeah, there are greater risks with non-investment grade debt if interest rates move in a certain direction. But what you're saying is I'm not even thinking about that stuff, right? I'm building my income factory. Right. And if I'm building income factory, that's kind of immaterial, right? Yeah.
Yeah, I'm in it through cycles because honestly, I'm taking the same kind of risk in my investments that JP Morgan and all these banks, have been taking for, hundreds of years. And they don't leave the market because interest rates are going to go up or down or whatever. I mean, they're in the credit markets investing to all these companies up and down the credit spectrum, but mostly at the lower end of the credit spectrum, because if you're a big company, you don't need to go to a bank if you can float a public bond or do commercial paper. I mean, you'll go to a different part of the bank and they'll underwrite that for you, but you don't have to deal with a loan officer who's going to examine your credit and make a decision about your credit as a normal, non-investment grade company would. So I'm taking the same risks, and investing through funds. I don't invest in individual companies, but through funds and in the same market that banks are. And they're in those markets up and down through all sorts of cycles, and they do fine.
Right. So what you're doing here is you're really borrowing the Wall Street, credit playbook, just making it available to the average investor here. So, all right, let's get down to the brass tacks. So for somebody who says, okay, this sounds really interesting, Steven, maybe I haven't done much of this in the past. How would you recommend they start approaching investing in credit? And I'll cede your answer a little bit. Like, I'm assuming diversification is somewhat important because you want to have the ability to withstand a catastrophic failure of one of these companies if it does default, right? But beyond that, I think you mentioned that you're not necessarily buying the individual bonds themselves directly from the companies. You're investing in ETFs. Explain how you do that, and where can people go to get ideas around this? And maybe this is a
Sure.
good time to tell people about what you do, with your service, where you're kind of identifying a lot of opportunities for folks. But how can people learn which vehicles are out there to invest in?
Yeah. Well, I started doing this myself and learning more about it through a site called Seeking Alpha that I started reading and writing occasional articles for probably 15 years ago or so. Seeking Alpha is a worldwide investment site that I think many of your viewers probably already know about. Then I started writing articles and started calling it the Income Factory, and then wrote a book 5 years ago. And then a couple of years after that, I started my service on Seeking Alpha. They will host subscription services for individual writers. So I have a service the same way, I guess, Substack and some of these other outfits do. And so I have a service called Inside the Income Factory on Seeking Alpha. Anyone who wants to Google my name, Steven Bavaria, or the Income Factory would find would find the sites, the Seeking Alpha site, and other sites about it, and would find their way to Seeking Alpha. But the what's the point of all this? I started. Oh yes, I started buying closed-end funds, and I don't know how much your viewers know about closed-end funds, but they're mutual funds. But because they're closed-end, the fund company itself does not redeem your fund, does not sell you the fund or redeem it for you on a daily basis. You buy it on the market, like it's like an investment company, but it's a fund. And then when you want out of it, you sell your shares on the market, which means that the net asset value of the fund can actually diverge up or down from the market price of the fund at any given time, which is kind of neat. It's not as liquid a market, but it also means you don't have the risk of a run on the fund the way you do on a regular mutual fund, where the company that sponsors it has to redeem your shares every day at some price. So closed-end funds are really attractive vehicles for investing in less liquid securities. And a lot of credit assets are less liquid in that they don't have big public markets. So senior loans, I mean, there are markets for senior loans, and banks and other large investors will buy senior loans, but they do it in, $1 million chunks and that sort of thing. So they're not sold in a public market that the retail investor can participate in, but they're great to invest in through funds. So I invest in senior loan funds in the closed-end fund market, and I also invest in high-yield bond funds in the closed-end market. And now there are even some of these other funds that invest in more exotic securities like collateralized loan obligations, which are a sort of a securitized, the way all of our mortgages and auto loans and appliance loans get securitized and wrapped up in bundles and then sold in the institutional market. Well, senior loans, secured loans, corporate loans, they are securitized into like bundles, and they're bought by these entities called collateralized loan obligations, which are they're leveraged pools of loans. So you can buy the equity of these CLOs, and then it's kind of like a virtual bank where you're buying the equity of a pool of loans, which is where the leverage is leveraged about 10 times. And then they also sell intermediate debt that's rated BB and BBB. So there are a whole lot of different ways to invest in these CLOs at different levels of their capital structure. But the point is, you've got closed-end funds that buy high-yield bonds, senior loans, these CLOs, and then you have some funds that buy a mixture of them so that they can move from one to the other and be kind of opportunistic. So you've got some very, very sophisticated players who run these funds.
All right, Stephen. So number of great things here. First off, so you as we said earlier, you tend to buy through vehicles like these closed-end funds rather than assembling your own portfolio of the individual credit instruments themselves. I believe there's a number of reasons that you do that, but an important one, I think I remember from our previous conversation, is that you want to leverage the expertise of the portfolio managers here. That while you're a smart investor, a number of these funds are being run by people who have been doing this their entire careers, year in, year out. They have the insider benefits of being well connected inside Wall Street. They really have the ability to kind of build the best books of business, get the best deals that are out there. You're nodding, I think, as I'm saying this, but is this an important component of why you're buying these funds too?
Absolutely. I'm investing in the expertise of professionals. And I mean, some of the firms that do this are well-known firms. You got like Mass Mutual, which operates under the name Barings now, which it acquired a few years ago. They've got a number of funds out there in high yield and senior loans, and they're just excellent because they've been doing this for many years. I used to write about them when I was a journalist 30 years ago and covering the private placement market, and they were one of the top names. Ares, Apollo, Blackstone. You've got some really solid groups that have been in this market for years, and I don't, I don't have the money to buy individual tranches of high yield bonds and loans anyway, and most retail investors would not. But you want to have the diversification, So it's doubly diversified in that I'll buy a fund managed by an Ares or Apollo or whoever, but then and within that fund, they'll have, hundreds of separate loans or bonds. But then I'll also buy a portfolio of a number of funds. So I've got diversification on top of diversification. And that's how you want to make sure that if the default rate for the whole market is only 1 or 2%, that you share in that. And in fact, a lot of if these people are good enough, they'll have lower default rates than the whole market. But I'm assuming that they're not that smart. I just want to make sure that they're as smart as their competitors in the market. One other thing you might find interesting is that we've been hearing a lot lately from professional media people and big time money managers about the private credit market, as though it's been a recently discovered thing in the last year or so, and a lot of people have been investing in it, and you've got a growth of investment opportunities in this private credit market. Well, these institutions, some of which I mentioned, and a lot of prudential, big insurance companies, they've been doing private credit for generations. It used to be called private placements, and all these insurance companies would do it, and it was a way to buy the bonds of corporations without going through the major banks to do so. But this has been a huge market, very successful. So a lot of the people who are now sponsoring funds or creating business development companies, which I didn't mention earlier, but that's another way to get involved in credit investing. Business development companies, which do private loans, private bonds, generally secured by collateral, to companies without going through the banking system. But all of these are great sort of opportunities for retail investors now that we didn't have 20 years ago in many cases. And the other advantage is that the borrowers are often owned by private equity firms, and the large investors, the big credit shops, are all very tight with private equity firms. So it's great to have your borrowers owned by a private equity firm that you also have a relationship with. If that borrower gets into trouble, then you've got a partner in the private equity firm to work with to try to work it out.
Okay, fascinating. Okay, well, look, what I love about this topic, just of income investing, is there are all these different asset classes that I think the average investor is unaware of or has only heard of tangentially, but doesn't know enough about to feel confident considering investing in. Which means, Steven, we can hopefully bring you back on again and again in this program to do kind of deep dives in, say, let's do a video on CLOs or on these BDCs, these business development companies, or master limited partnerships, or any of the other things that you invest in the income factory. Back to the closed-end funds for a quick second. You mentioned that the assets inside them are less liquid, and I just don't want folks to get the wrong impression here. So while the assets might be, yes, less liquid inside the funds, these funds hold, tons of different assets there. So the funds aren't going to have a liquidity problem. And you, as an investor in the closed-end fund, you can still, if you decide you need to, you can sell your shares on a daily basis. It's not like you're locked up in some sort of illiquid vehicle, correct?
Absolutely. No, I can go on to Fidelity or Vanguard or wherever you do your investing, and in a literally in 30 seconds of a few clicks, I can sell any of my closed-end funds at their current price. No, they are great vehicles for owning assets that may not be as liquid as a stock or a big public bond would be, but the funds themselves are liquid. Absolutely. Now, their prices will vary on the market, just like any other stock's price. So from time to time, the assets in the fund itself may be worth more than what the net asset value of the fund is worth, which then would make that fund a real bargain. You go into this market, you identify funds you like because they're of their record and everything, and then you wait sometimes weeks, days, weeks, until their price drops to where they're more perhaps at a discount rather than at a premium. That's another element of investing in closed-end funds that can work to your advantage if you're patient about it.
I'm glad you mentioned that because I was just going to bring that up, which is not only are they a good vehicle for owning these assets you're talking about, but given their nature, because they sometimes trade at a premium or a discount, they give you the opportunity to buy in at a discount if you're a savvy, investor paying attention. So you can actually buy these assets even at a better value. All right. Well, look, I know that you are pretty generous in sharing the individual tickers of a lot of these funds and other assets that you invest in. I think the best way, folks, to find out what Steven's, which tickers are on his radar screen at any current given time is to do one of two things. One of is to go and follow Steven. And Steven, I think you already gave the title of your site there through Seeking Alpha, right? Inside the Income Factory. So when I edit this, I'll put it up on the screen so folks know where to go. And folks, there'll be a link to it as well inside the description of this video. But also, Steven, you have very generously agreed to participate on the faculty of the upcoming Fall Online Conference for Thoughtful Money. And there, we'll ask you to share the tickers of some of the funds that have your attention most right now. So folks, if you haven't bought your ticket yet for the fall conference, you can go do that at thoughtfulmoney.com/conference. And if you go secure your ticket now, you can lock in our deepest early bird price discount. And a reminder that above and beyond that price discount, if you are a subscriber to our premium subscriber to our Substack, then you'll get an additional $50 off that early bird price. So if you want to hear Steven's top picks, that's definitely a great way to hear them. All right, Steven. Well, look, as we wrap up here, is there anything else about credit investing that we haven't covered yet that you think is worth putting on the radar of somebody who's newly considering investing in this space?
That's a tough one. We've covered a lot today. I can't emphasize enough, I think, how important it is to not just evaluate funds, even if you go into this sector, to not just evaluate funds on price and discount and distribution yield, because there are a lot. You can chase yield in this area because there's some very high yielding funds, and some of them are great buys and worth it, and others are kind of, I think, yield traps, if you will. So the important thing is to look at everything you would normally look at when making an investment, and especially confine yourself to sponsors, managers who really have long-term experience and are kind of well-known names in the field. Because I feel, more than anything, I just want to be investing with people who I trust because they've been doing it for a long time. And that's more important to me than sometimes maximizing the yield, for example.
Yeah. All right. Well, look, very well said. And folks, I'll give my quick usual pitch here, but when doing any kind of investing that you don't have a lot of experience with, highly recommend that you do so following the guidance of a professional. And in Steven's case, you can go and you can subscribe to his service and kind of look over his shoulder and use him as your mentor in terms of learning how to evaluate these things and how to build a portfolio. And again, you can look over his shoulder and copy a lot of what he's doing and recommending. If you want a financial quarterback who can just do all that for you, highly recommend you find a good professional financial advisor who is experienced in building income factories of the type that Steven mentions. You know, if you look at the average financial advisor out there, there aren't a ton that really adopt this type of approach. So make sure that you know, you do the work to find a good one. If you've got a good one who can do that for you, great, stick with them. If not, then consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses. They do have familiarity in working with these types of instruments. To do that, just go to thoughtfulmoney.com. Just fill out the short form there. Reminder, these consultations are free. There's no commitment to work with these guys. It's just a free service that they offer. All right, Steven, as we wrap up here, I'm almost not going to ask this question, but you know, a lot of the people that I have on this program, a lot of the analysts, you know, I would say on average are fairly pessimistic about where the economy is headed right now. I think they think the risk of recession is uncomfortably high, we'll say. And so a lot of people are saying, I'm assuming a lot of viewers are still wrestling with the like, you know, should I get into this whole, you know, investing in credit space if we're going to go, if we might go into a period of time that might have higher default rates because we fall into recession. And I think you've already answered that question multiple times here, which is, from your perspective, you're not that worried because the way you're investing, if we have, you know, average default rates that we see in the average recession, or maybe even aggressive default rates that we see in an average recession, mathematically, the default rate, whatever those default rates are, they still should be low enough that it's not going to overwhelm the returns that an investor should see even in a recession year. Is that true?
Yes, I think that's true. And I'd also like to say a lot of this decision, how safe do I want to be, will be driven by your own, everybody has their own risk reward sort of comfort level. And also it's driven by our need. You know, personally, I'll admit, if I had a lot more cash, I mean, if I were much wealthier, that I could invest in much safer investments, only investment grade bonds and shorter term treasuries, and I could live on 3 and 4% yields, I might do it. But personally, and most of the people I write for, we can't afford to be out of the market completely, you know, and just go for really low yields and, you know, low returns and the kind of safety that might provide. Safety, if it doesn't give you enough income to live on, is not safe. So I'm sort of assuming that I need to be in the market, and my choices are equities and traditional sort of balanced approaches where you might have 60% equity and 40% in fixed income of this sort I described earlier, where you're betting on interest rates and making very little money. Or you find the safest way to invest and still get a real return of 8, 9, 10%, but by minimizing the risks and the unpredictability within the range of investments that could give me that kind of return. So what I'm basically saying is, you know, if your choice is between a traditional income, a traditional equity strategy where you might be in an index fund or whatever, and that's a great way to invest, but you're going to have ups and downs during it, or to have an income factory approach where you're getting your 8, 9, 10%, and it's relatively predictable as far as what you're going to make, even in a period of recession or low economic growth. For me, it's more predictable. But is it totally without risk? No. I mean, none of these, investing in anything is not without risk unless you're just staying close to cash.
Right, right. But at the end of the day, for folks that are on the conservative side of risk return, again, I'm not trying to put words in your mouth, but your approach, you would say, definitely has a better trade-off in risk return, especially going to recessions, say that the standard, sort of 60-40 equity portfolio.
That's my opinion. I mean, we're kind of in territory that we've never been in before as far as some of the risks we face over the next year. But I feel that our economy and the people who run it, the CEOs and senior people of all of our corporations are very well compensated and have a lot of skin in the game to muddle through, to keep their companies alive and to muddle through whatever is thrown at us. That's really how I look at it. So
Right.
with
And that's
credit,
all you need. For you, success is muddle through is just fine, right?
absolutely. We just got to muddle through whatever happens. And I'm ready to do that.
Again, folks, don't forget that Steven's going to be presenting at our conference, and we'll be sharing specific tickers there of a lot of the funds that are most on his radar screen at that time. So to sign up for that conference and lock in the early bird price discount, again, just go to thoughtfulmoney.com/conference. Steven, it's been wonderful having you on. Look forward to having you back on again soon, and especially looking forward to seeing you at the conference at Saturday, October 19th.
Thank you, Adam. A pleasure.
All right, well, now's the time in the program where we bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money. I'm joined as usual by lead partners John Lodra and Mike Preston. Mike, why don't we start with you? What were some of your key takeaways to this discussion with Steven? Particularly because we tend to, for better or worse, focus more on the equity side of things. I really appreciate Steven bringing things over into the fixed income and credit side of the investing channel here. What were some of the key things you took away?
Really enjoyed that talk with Steve. Adam was a really enjoyable talk and something a little bit different. And not to say that we don't talk about income investing on this channel, but certainly it's not a primary focus. So I really appreciated you bringing Steve on, and who has a focus on credit investing. So from Steve's perspective, he wants to invest kind of in a slow-moving fashion over a full market cycle. He's not likely to be in or out. He's not likely to be a trader. He's not likely to be tactical. What he's looking at is an income stream of 8 to 10%, I believe he said. And he pointed out that during the great financial crisis, there was a default rate that maxed out at around 10%, and that you might get back 40 to 60% even in defaults. And that was the worst that it's ever been. In the longer term, he's expecting around maybe a 2% loss net due to default. So if he targets 10% income stream and he loses maybe 2% to defaults, he's still netting out around an 8% income. And I like how he calls his idea, or his focus, the income factory. That's what he talks a lot about, and he's got books and things like that. The income factory, and the output of that income factory are these income streams. And you can choose to either consume those income streams if you're in retirement, or you can choose to reinvest those income streams and more income streams. Like a factory would invest profits in people, plant, and equipment. If you're pre-retirement, you don't need the income, you can choose to reinvest those income streams in so that you can get more income streams, and you can get maybe 11 or 12 or 15 or 20% even over the years of your original investment in income. And that's kind of what it's all about. Ultimately, there's a lot of people that probably most of us know that have started to build rental properties early in their life. I know there's a lot where I live in New England, people that have bought these 3-deckers and started off with one and maybe have 15 or 20 now. That's another form of an income factory, all these rental properties that throw off income. Because after all, what we really want to consume is income, not capital. And so there's a number of different ways that Steve talked about investing for income, and I think the word that you used was invest like a turtle, because there's bulls, bears, and turtles, and you said invest like a turtle for the long run. And Steve mentioned, yes, maybe Aesop and Aesop's fable had maybe been onto something here if it could be applied to investing. So I think it makes a lot of sense. It's not necessarily where we focus. We care about income, but we have other tools that I think that we like to use for income generation. And just bear in mind that there's many, many different ways to achieve an outcome here. And yes, we all need to eventually have income, and we spend income. And the way Steve does it, through a number of different vehicles, including he talked a lot about closed-end funds. We can get a little bit more into what closed-end funds are and why they can make sense for this space. We happen to agree with him that closed-end funds probably make sense for income investing, but there's more ways to generate income. And so Steve's way is a good way, but not the only way. At New Harbor, we like to use options. Not a lot of people know how to use options, but options can also produce a heck of a lot of income, and you can capture something called volatility. And so I would say that Steve's method is more of a set it and forget it, sit back in your chair and let your income come in. New Harbor's way is probably a little more tactical, requires a little bit more maneuvering, but is no less valid. Both forms of income, both an income from bonds and from options, for instance, are taxable as income. But a lot of people, like Steve pointed out, have money in 401ks and retirement plans where income is not presently taxable.
Yeah. Hey, Michael, let me just jump in on that point. So in this conversation with Steven, we really drilled into the credit investing side. In his previous appearance here, we did a much more broad discussion over the income factory approach in general. And just want to point out that he has things in there like covered call funds, right? So he actually would agree with you, which is, hey, there's many different ways to generate income, and creating a diversified portfolio that basically includes all of those different approaches into the overall soup is a good way to do it. So I don't think he'd be disagreeing with anything you're saying there.
Well, great. Thanks for pointing that out. I didn't see that other talk that you had and the other things. So yeah, we focus on options and capital gains. Steve focuses on total income with a variety of different things, including options, like you just said. So that's good. Closed-end funds, I guess I just mentioned one or two things about them. They often trade at discounts, as Steve said. They often hold illiquid investments, and they are almost always run by professionals. So he has no qualms with hiring professionals that run these closed-end funds. I think you've got to do your research. There's a bit of research, and there's a number of good websites you can use to research stats like discount to net asset value, and you can see if the closed-end funds are leveraged or not. A lot of times closed-end funds will use credit and be leveraged to some extent. So you're actually magnifying your gains or losses. That's something to be aware of. But overall, I thought it was a very informative thing. I can't help but say one thing before I stop here, though. I was just noticing that gold and silver as well. I mean, I just noticed, I was on Twitter and just noticed somebody threw up a chart. Something I didn't even realize is that gold bars, as they're stored in the depository, and central banks store them this way, often are 400-ounce bars. And with gold trading above 2,500 here, a gold bar now trades for about $1 million for the first time ever. So I feel like I need to throw that in there because gold kind of has a bad rap in that it doesn't produce an income. So it's kind of like the anti-income investment, but I still think it has a place, and you can even create income from gold and silver by selling options against certain vehicles or selling options against mining shares. So I just thought I'd mention that too. I know it might be a stretch to connect the two, but I think it still has a place.
No, I think it's important because, as you said, one of the knocks on gold is it produces no income. And I shouldn't speak for Steven. I can say that, he even said in this previous conversation, hey, I still own equities too. So he's not, I think he'd be the first to say is don't have a portfolio that is 100% geared towards any single strategy. Have your income factory, have some things on the equity side. And I would imagine, and I'll ask him the next time I see him, where he thinks gold might fit into the picture. And actually, we can ask him coming up at the Thoughtful Money Fall Conference, because Steven's going to be one of the speakers there. So, Mike, if I forget to ask him then, why don't you ask him directly? And also just a note for folks, Steven, if you're interested in building an income factory for yourself, really one of two ways to do it. You can do it yourself, DIY, or you can work with a professional financial advisor who understands these instruments, like the team here at New Harbor. But if you want to do it yourself, obviously you can go sign up for Steven's service there that he offers. And he shares, specific companies. It's like looking over his shoulder. He'll say, okay, this month I ended up, buying this new fund or whatever at this price, or I'm thinking of buying this fund at this price because it looks like it's at a good discount, and here's why I like the fund. So anyways, if you can obviously go do that, or if you come watch the Thoughtful Money Fall Conference, Steven's going to be sharing his top tickers then too, so you'll get to hear what they are at the conference. All right, Mike, and one other thing that you said too, I just want to react to is, folks like John Hussman. I know you guys in general, along with many folks, are concerned about the high levels of overvaluation of today's markets. As I think I started this video off with, the Buffett Indicator is almost back at 200%, one of the most extreme readings it's had in its history. So as folks like John Hussman calculate, their forward projected returns for the S&P over the next decade are negative, right? So you were talking earlier about how Steven's targeting like an 8 to 10% return in his income factory. To get that in stocks, you would start with a 1.5% average dividend that stocks pay, but then you'd have to make up the difference in positive return annually, right? Somewhere around 8% on top of that, right? Well, if we're entering into the type of future that folks like Hussman thinks we're entering into because of today's level of overvaluations, you may actually not get that 8% positive annual return. In fact, it might be zero or negative, right? The only positive percent of your portfolio on average might just be that 1.5% dividends, where Steven's portfolio will keep churning out that 8 to 10% year after year after year, as long as those companies remain in business. Right. And yes, there is that existential risk that the companies in his portfolio face. But if you're on the equity side, you have that exact same existential risk, plus you have all the other risks that are out there, the entrepreneurial risk, the market overvaluation risk, et cetera. So I just want to say, if you are concerned about today's level of overvaluation and you place faith in the analysis of folks like Hussman, man, Steven's income factory all of a sudden really starts to look pretty attractive in comparison.
Yeah, I completely agree, and I like Steven's approach and his, and it's kind of more of a calm way to invest versus almost a passive way. Although I don't want to say it's passive. I think there's a lot of research and a lot of decision making that goes into the income factory. But once these things are set up, he's likely to hold through cycles. So it's a little bit more passive in that way. And
right.
I think that's an okay way to do it.
It's just contracts, right? You're saying,
yeah,
hey, as long as the contract looks good, I'm going to buy it, and then I've got confidence it's going to pay me this, like clockwork going forward. And I guess the one thing he probably does after that, active-wise, is just monitoring the company to make sure that it's not in danger of going out of business. I guess if he thought it was, maybe he would end a contract early. But beyond that indicator, to your point, Mike, it's pretty much, just let the contract play out for its duration.
Yeah, it's like collecting the income properties or the three deckers, like where I live in Massachusetts. You collect them over time, and maybe over decades you have 20 or 30 of them. And you still got to maintain them, and God forbid something happens, and you have a fire in one of them. You've got to exercise your insurance. You've got to rebuild, etc. You got to maintain it, but by and large, you're collecting those incomes. If you're a passive investor in the S&P 500, like you just mentioned, at current valuations, you should expect maybe minus 5% a year for the next 10 years. Now, whether that happens slowly or it happens all at once in a minus 50% crash followed by an L-shaped sideways move, I don't know. But you can collect these income contracts like Steve talks about, and I think there's very little maintenance over time. And it's certainly something that we think about incorporating at New Harbor, even if it's not our primary focus. But, we're continuing to do other things like we mentioned earlier. We focus more on options. We certainly consider and look at closed-end funds, although none of them are in the portfolio right now. Overall, I've just thought that Steve's talk was really informative, and a lot of people out there should think about that and listen to that and really hone in on the closed-end funds that was talked about. There are some opportunities in that space if you do your research.
All right, great. John, let's go to you. Feel free to add whatever you want on top of what Mike and I just discussed, and then I want to get to some of the developments that have been happening today.
Yeah, I too very much appreciated Steven's comments, and the thing I want to emphasize that he spoke about and probably would have loved to speak about more is the time and the care that one should take in sifting through the wheat from the chaff in this kind of body of opportunity called income investment. Because there is not one size fits all, and in fact, and he talked about it. The whole reason we have referred to chasing yield is because there are plenty of vehicles out there that shine a flashy high yield out there, but the likelihood of that yield actually being realized is questionable. So it really is important to do your homework here, and we are happy to have discussions with folks. We know a lot about this topic, and some of the things I'll highlight. I got a couple of charts just to kind of sensitize viewers to the kinds of things that we would want to raise on their behalf, and I'm sure Stephen would agree with this. Let's just start with the landscape of interest rates, because when he talks about credit, what he's really talking about, for folks that don't understand, he's talking about bonds. When you invest in bonds, you're a lender to some entity. Treasury bonds involves you lending to the U.S. government. When you talk about credit, we start to talk about corporate bonds, where you lend to companies of different qualities. So this is a chart showing the yields for different qualities of credit. So for example, AAA is that's the most credit-worthy corporate bond you can make. And right now the yields are about 4.39 on US AAA corporate credit. At the other end of the spectrum, you get really high yield, what are called junk bonds. These are less credit-worthy companies. This is the lower end of the junk bond spectrum. You can get yields over 13%. But with that comes a higher degree of risk of default. So doing your homework as to those companies that are likely to be able to avoid that existential risk is really important. So the credit quality, especially when you look in a closed-end fund type of thing, really understanding the portfolio composition is really important. I did want to sensitize, I do think that there is this a little bit of a time bomb in the credit space in the form of covenant-light loans. Covenant-light loans are loans that are issued with lacking some of the protections to bond investors that historically have been the case. So for example, a common feature in a corporate bond loan is a debt to service coverage ratio. So if companies fall below their ability to have a certain ratio of free cash flow above debt requirements, they can be in technical default and the lender can call back the loan. Well, in the wake of, since the great financial crisis, the volume and the percentage share of issuance that are covenant light have gone off the chart. So that's an area that I think is yet to be tested. We may find that default rates end up being higher or more stressed than in prior episodes because of this kind of quality situation beneath the surface. And I did also want to talk about dividends. I know the topic of most of Steve's talk was credit, but when you look at stock dividend paying type funds, this year Intel, for example, cut its dividend after many years of having a dividend. Those aren't birthright, kind of gifts to investors. Sometimes, especially during times of stress. So, for example, you see here during the tech bubble and the housing bubble, and even during the COVID bubble, the spike in a number of companies announcing dividend cuts, were off the charts. So these are all things that Steven talked about, and makes it really important for an investor to be very careful. I did want to talk about just closed-end funds. Usually the dividends that they issue are a combination of passing through yield of the instruments, whether they're credit instruments or dividends, as well as sometimes a projection by the management of that fund of future gains. They want to distribute those gains in what they call managed distributions. But there are a whole bunch of, certainly not the majority, but there are plenty of closed-end funds out there that in their dividend, they're basically returning investors' own capital. And it's perhaps the most destructive form of asset management, because essentially they're collecting a fee to give you your money back. So it's really important to do your homework on these vehicles. Again, I'm sure Steven is well attuned to this and would advise the same. And that's why I just want to kind of put out those couple of hot button items to sense.
Yeah, no, I appreciate you mentioning all that. And I think the key takeaway here for viewers that are intrigued by Steven's approach and saying, hey, maybe I want to start doing some of this myself, is unless you have a lot of experience doing this, you really should be leveraging the expertise of somebody who is, well experienced in it. And so, that's either buying a newsletter and following somebody like Steven, and like I said, looking over his shoulder at his trades, or working with a firm, maybe even one like yours, John and Mike, where, you guys can be taking them by the hand and telling them, okay, this is what you want to be looking for when you're looking at a closed-end fund. If you're telling me you're interested in this one, let's take a look at it. Is this one of the ones that's basically just, giving you your own money back and taking a fee, or is it one of the better ones, right? So So I think that's a really important point to underscore here, which is if you're new in this space, just like we've said, around hedging, working with options, don't learn by the school of hard knocks, just doing it willy-nilly on your own for the first time. Work under the guidance of an individual or a firm professional who's very well experienced in this. All right, well, look, let's move on in just a few minutes we have left to talk about a couple of things. The thing I really want to drill into, because it's something that we've talked on this channel for a lot for the past, that I've been talking about for probably almost the past 2 years, but certainly since Thoughtful Money, this channel has been in existence, which is that the jobs numbers have looked super suspect for very, very long. And I've raised the question of, are we basically flying by a faulty set of instrumentation here? And I think the debate on that is now over. This morning, I think it was the Philly Fed put out the annual revisions for the payroll numbers. And I think that they have said that the payroll numbers were overstated in 2023 by over 800,000 jobs. And I think it averages out to the corrected payroll numbers was we added about 130,000 payrolls on average a month in 2023 versus the previously reported 230,000. So that's getting close to about half of the jobs that we thought were created last year weren't. And so, we're all of a sudden just realizing that now. Now, really interesting and maybe somewhat infuriatingly, markets have shrugged it off so far. Seems to be kind of a nothing burger effect. My opinion, you guys don't have to share this, but is that this is something that can't be ignored, right? Policy was set based upon that bad data. Markets have been trading, bets have been placed in the markets for well over a year based on that faulty data. There is going to have to, at some point, be repricing for the newer, much more likely truer understanding of what reality is. Shoes not clearly dropping in the first couple hours of trading here. But anyways, love to hear what you guys think about it. John, why don't we stay with you and then we'll come to you, Mike.
Sure. Yeah, that revision today was big, and there was an expectation there would be a big downward revision. Debatable as to whether the markets expected that big. Apparently, the markets did because they're doing a nothing burger pretty much in response. But that was the largest revision, I think, since the Great Financial Crisis. So
it's the second largest in the history of the series.
Yeah, in history too. Yeah, so probably even more important to note that. Look, we got some important things coming up. Obviously, September's Fed meeting is a really highly watched thing. The market's been gyrating a little bit about how much the Fed is likely to cut. It's pretty clear that the Fed, or at least the markets and the Fed, seem to have turned their attention away from the inflation part of the Fed's mandate and more towards the employment. And this revision today perhaps really emphasizes that that's the thing the Fed is going to be and should be watching more closely right now. It's interesting because the stock market is almost back to all-time highs. In fact, some indices, equal weighted S&P, for example, just registered a new all-time high. So we have this kind of face-off, I guess I would say, between the bond and credit markets and the stock markets. Something's got to give in terms of, certainly if there is job destruction like these numbers start to project, it very likely falls through into contraction in economic activity. And I don't think that's nearly priced in. Either the bond market's got it wrong and stock market's got it wrong, and perhaps they both do in some degree. So yeah, I think we have some pent up moves in the markets here. The recent scream higher in the stock markets since the August 5th panic sell low. It was a really panic sell. The VIX spiked to over 65, and in a matter of days had the biggest VIX crush back down to quote unquote normal in history. We had 8 straight days up in the S&P. Those moves were very extreme by any historical standards. But if we look at what was underlying that, it looks like a lot of retail investors piling in, trying to buy some of these meme stocks, perhaps at what they considered discounts. But we stand here with sentiment indicators and positioning indicators that are pretty extreme. We have really, really low short interest in S&P and the NASDAQ. We have very long, net equity positioning across institutional managers. So there's pretty extreme move here, and it's reflected in the extremities of positioning and sentiment. But yeah, we're going to be in for an interesting bunch of months, we think, here.
Well, I agree with you. And just on comment you made, likely one's right, stocks or bonds. Bond market 10 years down to 3.78 on the day we're talking here, which is, fairly low reading given where it's been for the rest of the year so far. And I just want to note that when the stock market and the bond market tend to be telling different stories, the bond market has a high preponderance of being proven to be the right one over time. So again, time will tell, but we'll see here. My bet is on what the bond market's telling us here. I also just want to note too, the vast downward correction in jobs we just talked about, that is explanatory of a lot of the weakness the economic weakness that we're seeing on the consumer side, especially in these consumer brands that are reporting, dramatically or concerningly lower quarterly performance and outlook, right? And we've seen this across, all sorts of big brands like Starbucks and Home Depot and Lowe's and even parts of Walmart's business and all that type of stuff. I do want to note one, so today there was another story like that. Macy's just came out with disappointing results and even more disappointing guidance, and they're getting hammered. But bucking this is Target. So Target's actually up pretty big today. They had great performance in the second quarter. But I just want to note that it was basically resulting from pretty dramatic price slashing in their business. So, you can say that, well, I mean, maybe in some ways that is a sign of a weakening consumer where they're all flocking to where the discounts are greatest right now. So who knows? It could be a sign. It could be a sign that the consumers, maybe not as tapped out as we thought, but actually because it's so built on price cuts, I'm a little suspicious looking at that, and I actually think it might be a sign of a weakening consumer, not a strengthening one. Mike, we'll hand the baton to you. Make any comments you want as we begin to wrap things up here, and then I'll come in and close things up.
Yeah, on the jobs revision, it makes it hard to believe or hard to know what's real and what isn't real, So there's a huge revision, like the 30+%, I think, revision, the second largest in history. And yet the market hasn't cared because the market's on to the next thing. The market is all about, what can I eat today? That's doesn't really care so much about the future. It really wants instant results, and that's just kind of the market we're in right now. As John pointed out, we had a VIX spike to 65 last Monday on the Bank of Japan and strengthening yen news, and then it just collapsed. And we had panic readings, short-term panic readings, and now we're getting back to short-term euphoric readings, all within 2 weeks. So it's kind of crazy. It's probably going to be more of the same for a while. So what does the market care about right now? Well, obviously not about the jobs, because it hasn't even really reacted, and we're sitting right here, right next to all-time highs on the S&P. It'll take one good day to get us through there. I'd expect that to likely happen. The market seems to be front-running, interest rate cuts. You'd think that that's already baked into the cake, and certainly the bond market is saying that, with the 10-year yield down in the high threes again. And so who knows? We have a quote unquote permanently high plateau, or what seems like one from a valuation perspective, but I don't think it's going to stay there. I think we get perhaps one more move higher, one more little blow off top here, and then a big drop. And nobody knows the future, particularly the short-term future. But if we had to guess, I'd say something in the next couple of months, another move higher, maybe even through 6,000 on the S&P, followed by a drop, either before the election or after the election. I think it really doesn't matter, and nor can we predict. But these are dangerous times, and when you can get a guaranteed income in Treasury bills of 5% on the short end, or if you listen to Steven's presentation, you can get 8 to 10% on more illiquid income type investments. Why risk it? Bottom line, why risk it? We're only about 40% in equities, and those equities are hedged in various different ways. Vast majority of the public is invested in 60-40 or 80-20 funds and have no idea what's coming. So, just be careful and think about reducing that risk. Give us a call if you want to chat about it. And so the last thing I'd say, again, on gold, as I mentioned earlier, sitting at 506 on the spot market right now. It's at that $2,500 target that we've talked about for a long time. If you're feeling overweighted, you can start dollar cost averaging out of it. If you haven't bought any yet, you can start dollar cost averaging into it, because we think it's probably going to go higher, maybe as high as 3,000 before a pullback. And it's likely to pull back when the stock market pulls back. So who knows? Maybe gold goes to 3,000 and then pulls back to 2,500 where we are today. That's why I say if you're overweighted, dollar cost average out of it, but it's not too late to have some. Silver is lagging, strangely enough. Silver's at 29.50. Should be up at around 34 or 35 based on the charts, but there's been a divergence in recent weeks and months. So who knows? Silver can have a big move in a short number of days, and kind of hope that it does. Gold stocks are hanging in there. GDX is knocking on the door at 40 or so. And over the last months and even years, last months and year, I should say, gold stocks are starting to close their underperformance. We expect them to continue to outperform gold. And so don't forget that part of your portfolio, even though it isn't paying a lot of income. I think that's probably the last thing I'd say there.
All right, well said, Mike. Okay, well, look, just to your point that, hey, it's dangerous times. You know, people are increasingly concerned about what might happen from here, especially with the uncertainty of the election coming up. I just want to note, I'm definitely seeing, you know, an increase in those types of questions from viewers of this channel and folks on my social media. And that is a huge reason, folks, why we do these conferences. And so, as I mentioned, we've got the fall conference coming up. Again, that's on Saturday, October 19th. Steven's going to be presenting at that faculty, but I'm going to try to do this from memory. So far, we have Lacey Hunt kicking it off with the keynote, which, if you've seen these before, you know how unbelievably concentrated that is, with amazing charts and knowledge. Many say that's worth the entire price of the conference in and of itself. We'll have Stephanie Pomboy there. We'll have Darius Dale. We'll have Thomas Honig, former Fed exec Thomas Honig. He's going to be interviewed by Danielle DiMartino Booth. We're going to have Mike Leibowitz talk about bonds. We'll then have Steven Bavaria on talking about how to construct, you know, more on how to construct the income factory portfolio. And again, he'll be sharing his the tickers of the funds and the companies that are of greatest interest to him at that point in time. We're going to have Brent Johnson giving an update on the outlook for the US dollar. We're then going to have Lynn Alden on to talk about ways in which to protect against the decline in purchasing power of fiat currencies like the US dollar. So she'll be talking about Bitcoin, precious metals, etc. We'll have Melody Wright there talking about the housing market. We'll have Rick Rule giving his latest stock picks on resource stocks, and Rick always brings a truckload of tickers for you to look into. And then, of course, we're going to have our financial advisory team there. So we'll have the guys here from New Harbor Financial. We'll have Lance Roberts from RIA, and we'll have Jonathan Wellham from Rocklink Partners up there in Canada. And I've got space there still for hopefully one or two more big names to come join. But as you can tell, that is by far the absolute best faculty we've ever had for one of these. Super excited for this conference. But also, I think the timing is maybe more timely this year than it's ever been, given all the uncertainty out there and people's hunger for trying to get a sense for what's most likely to be happening from here and how to position for it prudently. So folks, if you want to learn more about the conference, get your tickets for it, go to thoughtfulmoney.com/conference, and make sure, if you're interested, if you think you're going to go, make sure you go and buy your tickets soon so you can lock in the lowest early bird discount price that we're currently offering. And just as a reminder, if you're a premium subscriber to our Substack, you'll get an additional $50 off that early bird price. You get $50 off whatever the ticket price is, but get it now while you're getting it off of that lowest early bird price discount. All right, well, look, folks, if you've enjoyed this conversation, this focus on the income side of things, would like to see Steven come back on this channel again in the future. As I mentioned, there's all sorts of different parts of the income factory that we could dial into with him, whether it's, you know, collateralized debt obligations, whether it's the business development entities, whether it's covered call funds, whether it's master limited partnerships, all the different things that go into in his income portfolio. I'd love to bring him on for deep dives on each and every one of those if you folks are interested. So if you are, let me know in the comment section below. But if you'd like me to do that in general with Steven, please vote your support for that by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. And if if you'd like help in potentially constructing an income portfolio, in your own personal portfolio, as I said earlier, highly recommend you work with a professional to do that. If you'd like to get some help from one of the financial advisors that Thoughtful Money endorses, you can do that for free by scheduling one of these consultations with them. To do that, just go to thoughtfulmoney.com, fill out the short form there, and they'll be in touch with you with probably in just a couple hours to schedule that consultation. As a reminder, these things are totally free. There's no commitment to work with them. It's just a free public service they offer. And again, they're happy to talk to you about the income factory side of things. But obviously, if you've got other issues in your financial life you'd like to talk about, they're happy to talk with you about those as well. John and Mike, guys, thanks for hanging with me for yet another week. Really looking forward to seeing you guys in just a little less than 2 months at the conference as well. And look forward to seeing you guys next week to make sense of whatever's happened between now and then for everybody. Everybody else, thanks so much for watching.
We'll see you soon, Adam. Thanks again for having us.
See you next week, Adam. Thank you. Nice talk.